the typical archetype of successful founders is someone who has relevant experience within the industry vertical that they're building in. And that means it obviously differs, but have you spent 3 years, 5 years, 10 years working at a large financial services firm before you go, hey, I want to build a fintech company? And that gives you deep understanding of what it actually takes to build a financial services company. What are the compliance requirements? What are the data requirements around working with a large enterprise customer? What are the compliance requirements? But when it comes to pre-seed and seed, the biggest thing that we're really underwriting is the team, right? I'd say to a lesser degree, kind of the market that you're building in and the vertical that you're building in, but predominantly it's the team. And the earlier you go, the more you're really underwriting the team.
Thank you so much, Brenton, for joining me on the podcast today.
It's an absolute pleasure. I know a lot of your previous guests quite well, so given that, I take it as an honor to be here today. Thank you very much.
Thank you. Our guest today is Brenton Naicker, a venture capital investor, founder, and also startup advisor, currently serving as the principal and head of growth at Africa's leading blockchain-focused early-stage VC fund and accelerator, which is CVVC. CVVC is committed to supporting the next wave of African entrepreneurs and also innovators. It is absolutely great to have you here, Brenton. And so before we jump right into the conversation, if someone is tuning in for the first time, what do you think they would walk away with, from this conversation?
Well, my hope is one or two things. One, if they don't understand the incredible opportunity that blockchain presents for the African market, hopefully that conviction. And if they're already convicted and they're an early stage founder, hopefully some nuggets of wisdom and experience that I can share, whether that be in raising a round, whether that be in scaling across the African continent. So one of those two things is my hope.
Amazing. And so that's your cue, the audience to watch this podcast from, the start to the end. Now let's jump right into the human side of Brenton, right? I really want to go deep into who are you, what do you do, and what mission are you on?
Absolutely. So I think what really drives me is having this unique context kind of across this early stage venture stack. And what I mean by that is, I think I'm in the privileged role of having been a founder myself, having been an operator at a business that has been scaling massively across the African continent, particularly Binance, but then now having the investor hat on. So I'm really able to empathize with the journey that anyone across that stack is going through. And I think what really drives me is I think technology is the catalyst and probably the best catalyst at being able to drive change on the African continent. You make people's lives better. And it's incredibly exciting for me to wake up every day and speak to founders who are giving their lives to this mission of, either making payments better, making credit better, making the real estate sector better, and being able to hopefully play a small role in helping them achieve that. And, it's a job in which you can never get bored because every day you're speaking to incredibly passionate, incredibly intelligent people who in their own way are looking to kind of transform the world. And I think that's, what gets me out of bed every morning.
Absolutely. That's a great mission to help other people scale, right? So before we get right into this part, right, I want to sort of understand your background. What was life like growing up? And, what are some experience that you can share that has shaped you to be the person that you are now?
That's a great question. I'll try to keep it as short as possible. So I grew up in Durban. It's a little city in South Africa, a little bit less well known, sorry, than Cape Town and Johannesburg. Was part of a. So let me just close my WhatsApp quickly. And then I grew up kind of, I guess, with two driving forces behind me. Both kind of a strong academic head, So I was very strong academically, but then both on the sporting side. So I was a very avid rugby player. I was in a full rugby scholarship at Durban High School, which is one of the best rugby schools in South Africa. And I think that journey taught me a lot of things about hard work, about discipline, about teamwork. Um, and also grew up kind of um, by a single mom. So, I think it teaches you a lot about independence, really striving to achieve things. And I think these are kind of some of the early foundational things that pushed me. I think obviously, it's similar to a lot of cultures, right? In our household, in our culture, there was kind of like you're either a lawyer, a doctor, an accountant, and that was kind of your only career choices. Uh, and so very early on, I went to university in Cape Town to study quantitative finance, and the goal was to go into investment banking, right? So I was completely kind of drawn by the whole allure of Wall Street, wanting to work in that space. Um, and towards the end of my studies, I actually discovered the Bitcoin white paper. And, I thought not much of it in the beginning. I thought, a lot of people were making money. It was making a lot of headlines. So I was like, let me dig a little bit deeper into this thing, figure out what it is. And, selfishly, like, I'm sure I can figure it out and, I'll find a way to make some money off of this thing. And having kind of the background that I had by that stage, with the grounding in finance, was kind of towards the end of my university career. I had a good understanding of the way the financial world works conceptually, particularly things like the banking sector, fractional reserve banking, um, and I know it sounds a little bit poetic, but by the time I read the last word on the last page of the Bitcoin white paper, which again isn't a very long document, something immediately clicked for me. It's what we call in the industry, I was orange pilled. And ever since then, I knew that my mission, or at least my goals, had changed. And, from that time, I was really dedicated to trying to going into the space, working in the space. And that kind of, led me down a different career path than I had initially envisioned.
Yeah, right. So I guess that was like a pivotal moment. One of the questions that I also wanted to ask was like, what are three major pivotal moments, that significantly changed like the trajectory of your life? I think you've given us one, which is, going to study like quantitative finance and then stumbling on Bitcoin white paper and then sort of like changed like the trajectory of your career. Do you also want to share like two more pivotal moments so far?
Absolutely. I mean, this is a great question. So I'd say the other two that really stand out was, after I'd spent some time in the professional world and I was working in corporate, I decided I had this idea and I wanted to be a startup founder. And, the first thing you do, of course, apart from market research and building a product, etc., is you go out to raise money. So we were raising our pre-seed round, which, thankfully we managed to successfully raise. Um, but in that process, I very distinctly remember sitting on this side of the table, right? So on the startup founder side of the table, and just looking across and pitching these angel investors and these venture funds, and uh, just thinking like, man, like one day I would really love to be on the other side of that table. Like it's so incredible what they get to do. Um, and I think that was the second pivotal moment where I really, at least conceptually, fell in love with venture, and fell in love with venture investing. And I think the third was during my time at Binance. So it wasn't a specific moment per se, but it was more of an extended realization. So during my time at Binance, I started out kind of leading the South African market and ended up kind of leading our Pan African expansion. And when I saw the way that people were using crypto outside of South Africa, like in South Africa, the user behavior is still akin to kind of more developed markets, right? Where people look at crypto and digital assets as an investable asset class, as an asset allocation decision, right? So people were buying some Bitcoin, some ETH, a little bit of Shiba, with the expectation that the price would go up, right? That was kind of the core driver of user behavior in the South African market. But as I kind of launched additional markets like Ghana, like East Africa, like Francophone Africa, and we started to look at the user data and the user behavior, there were entire cohorts, and it was quite prevalent, of users across those markets who would never touch Bitcoin the whole time they would use the platform, never touch Ethereum. Their entire account was purely USDT. And that got me really, really curious. So obviously, we started to do a bit of a deep dive into like, oh, what are you using the platform for? Why USDT? Obviously, analyzing some of those transaction behaviors, and then just seeing businesses, making payments to suppliers in China, family members receiving remittances on platform in the form of USDT. Even we did a case study on a peer-to-peer merchant in Nigeria who was this relatively elder lady who was, selling things on the side of the road. And a lot of her business, she would operate off of Binance Pay and stable coins. And at any given time, she would be able to tell you, what the gas fees were on different networks, what was the best network to transfer USDT on, how to bridge different assets. And those are fairly technical things, right? Those are fairly technical things. And obviously, you would assume she's not a very technical person, but because of how much utility the technology gave her, she crossed that kind of educational barrier and forced herself to learn those things. And it was those collection of experiences that really embedded within me this fundamental belief that like this technology really has the ability to transform people's lives, beyond just the speculative elements of like, number go up. And I think that was probably the third pivotal moment to me where I was like, wow, this technology really has the ability to transform people's lives in Africa in a meaningful way. So I would say those are, in addition to the first moment that I shared, those are probably two pivotal moments in my career. I'm very blessed that they led to something. So I now am, able to operate in the blockchain venture space in Africa and kind of live out that mission.
Absolutely. I think that must have been like a really, really great moment for you. Understanding that other than just the speculative part, quite a number of persons are doing even other things with like the blockchain, especially like the utility. You must have paid a lot of attention, to be able to connect the dots and really like understand, the user behavior. Just still on like understanding your human side, based on all of these experiences, right? And also like the pivotal moment, how would you describe yourself in 3 words, right?
Oh, that's a really, really, that's a hard one. So if I were to break it down, not into three kind of sequential words, but three individual words, um, I would probably say optimistic. So I am the eternal optimist. So optimistic would be one. Um, I'd say empathetic would be another one. I really tend to resonate with people and the situations and their circumstances and their context. Um, and then I like to think driven, right? I always want more. I want to do more. I want to grow. So either driven or ambitious. So I'd say those three words probably sum me up quite well. At least I'd like to think so.
Yeah. So I really want to dwell on like the driven part. Earlier on you mentioned that you were trying to raise funds at the time, and then you saw like on the other flip side how like venture is all about, and you are like, oh, you really want to, get into this other side of the business. I really want to understand, by that drive, how did you find your way, into venture capital? Walk us through like your journey from, being a founder to working at Binance and also like, venture capital.
That's a great question. Look, I'd like the story to be a little bit more intentional than it is, but again, I think it's just just being tremendously blessed, because it kind of was um, an unintentional intentional draft. So um, during my time at Binance, I was kind of responsible for growth, partnerships, BD, and so that scaling all of the new markets across Africa. I think when I joined, we only had Nigeria live, so it was really about bringing all of the new markets online, building those teams, scaling out those markets. But once we'd scaled out those markets, I think internally I had a little bit more leeway to do some other stuffs within the organization. So some of that was, um, you know, helping to scale BNB chain across the African continent. So working on the developer and the startup ecosystem. So once again, through that, I got to interact with founders, with new projects, etc., quite a bit. But then also another, legend in the African blockchain space, Yele Bademosi, was actually intimately involved in Binance Labs when I had just joined. But by the time at this point in my journey, he had kind of left to be, a startup founder, and he was working on an incredible startup that was actually backed by Binance. It was, was a great kind of full circle moment. Um, but what that meant is that the team had started now, sharing deals with me from a Binance Labs perspective that were originating in Africa. But I was also now sourcing deals, for that team, Africa related deals. So, just by chance, I got to, spend a portion of my time during that time, in call it the venture space. Um, and then when CVVC launched into Africa, which was initially a public-private partnership with the Swiss government. So for everybody's context, they're based out in the Crypto Valley in Switzerland. So it's a town called Zug. They're a global VC investor with footprints across Abu Dhabi, Dubai, Lisbon. We've got team members in London. So a very big global presence. And they're exclusively or primarily a venture investor. When they launched here, I had the privilege of spending a lot of time with the management team because we did quite a few partnerships between Binance and CVVC when they launched. And then I fell in love with the vision. Some of the management team there, obviously saw some good in me as well. And after a bit of convincing, I made the decision to move across from, let's call it, part-time VC at Binance to becoming a full-time kind of venture investor for CVVC, running the African Blockchain Fund.
Amazing. I really love us to go into like what you do at CVVC now, and then learn from you as much as we can. But like one question pops in my mind right now, which is like for someone looking to, get their foot into venture capital, what's like one advice you'd give that person?
That's a great question, right? And people often ask me this, and there's no direct route. Like it's and I always say there's a difference between easy and simple. So it might not be easy, but it is simple to become a doctor. You study medicine, you specialize, you complete board exams, and you become a doctor. Venture is this interesting beast, right? It's similar with an accounting, right? You study accounting, you do a postgraduate diploma in accounting, you do 3 years of articles, you're a chartered accountant. Venture is interesting in the sense that there isn't a single career path, right? You can't particularly study venture capital at university. And there's a number of different paths into venture. So from an academic perspective, there tends to be quite a bit of crossover with investment banking, private equity backgrounds. So I think if you come from that world and you want to pivot into venture, there is a realistic route for you to do that much simpler. I'm assuming with a lot of the audience, we're kind of speaking with, what are some other unconventional routes to get into venture. And I think the best advice I can give someone who's really early on in their career that is really set that they want to become a venture investor, is probably one of two things. So, one, become a founder first, because there's no better kind of startup MBA than getting your hands dirty. But of course, not everybody has this big, audacious problem that they want to solve directly. And I think, in my view, one of the best, absolute best routes into venture is to join an early stage startup. Doesn't even need to be particularly early stage, but the beautiful thing about joining a startup early on, and I had the privilege of having this experience at Binance, where we were at this inflection point where we were really kind of scaling massively globally, is you get a lot of responsibility. There's a lot of expectation on you, but once you join a very big scale up, right? If you were to join Flutterwave today, it's very unlikely that you'll get to touch a lot of parts of the business. You'll either join the regulatory and legal side, the business side, the account executive side, the finance side. You'll often serve a very specific function. But the beauty of joining a startup at the seed stage or the Series A stage is, as you're scaling, as so many things are happening, if you're a high agency person and you're willing to take on a lot of responsibility, that responsibility will be given to you. So, your title might be on the operations team, but you'll get to work across compliance, growth, BD, finance. Those are generally small teams, a relatively flat organization. So the amount that you'll be able to learn about, like, the inside of a scaling startup is tremendous. So my advice to young people who really want to get into venture is become an operator first. So find a startup, look at Africa Big Deal, look at Tech Cabal, find startups who've just raised, seed rounds, Series A rounds. That's generally where you start to see these external hiring cycles. And join as early as you can and ask for as much responsibility as they'll give you across as many different parts of the business. And that is the best. To have an operator background is, I'd probably say, apart from kind of this investment banking route, is probably the other route that is really, really prominent in terms of getting into venture. So I would say that's the second piece of advice. The third piece of advice is start adding value to VC firms before you ask for a job. So, if you really like fintech, right? There's some incredible fintech funds in Africa, like the First Circle team, but also a lot of the generalist teams like Launch Africa, etc. They're all investing in the fintech space. Go out and find deals. Go out and find deals. Go out and write memos. And just start build a relationship with a partner or a principal, and just start sharing insights. Just start sharing deals. Just start sharing memos. Just start putting dots together between their portfolio and other companies who have just raised. So consistently start adding value. And then when those hiring cycles do open up, which is generally kind of, around raising fresh funds, you're already top of mind. They can see what you do. They can see the value that you add. They can see the network that you have in terms of being able to source deals. And that is, I'd probably say, the third thing that you can do proactively to kind of break into the venture space.
Really, really interesting. Thank you for that world of knowledge. The first part is being really technical, right? Because now, like, technicality here is like going down into like the rabbit hole, into like the weeds, understanding all of the moving parts. And other than that, also like sourcing deals for like VCs that or industries that you really want to work in, fintechs like you mentioned, right? Now let's go into like your day to day, right? As working with CVVC, what does it look like? Working as principal and also head of growth at CVVC, right? What's like your day to day? Because you mentioned you're always excited to wake up every morning and do stuff.
Good question. So, I mean, it changes constantly depending on what the current requirements are, right? Whether we're working on an active deal, whether there's no active deal in the pipeline. There's things that excite me less about the job and waking up, but need to be done. All of the kind of the administrative and the operational things. No one enjoys going through an annual audit. Um, but generally, I like to break my weeks up into kind of deeper work, top of funnel work, and then kind of portfolio management work. So what kind of the day to day really looks like is a lot of speaking to new founders, forming opinions about sectors. So I've got big blocks in my calendar every week where the goal is to just speak to new founders, learn about what they're building, start building relationships. Um, when we've got an active deal on the go, maybe a little bit less of that and more about kind of, doing deep market research, deep product research, due diligence. Um, you know, uh, I think the one thing that startup founders forget is as VCs, we also have to fundraise. So, just like you raise money from us, we've got to raise money from somewhere. So, we depending on where you are in the life cycle, you're also speaking to what are called limited partners. So our investors are called LPs or limited partners. So depending where we are in the life cycle, spending a lot of time speaking to LPs, articulating your thesis, speaking about your portfolio, and then portfolio management work, right? So that can either be proactive or reactive, right? So proactively, um, speaking to other tech partners, tech companies offshore that could be potentially valuable for your portfolio to work with. And then there's reactive, right? So, both good and bad. Sometimes our portfolio companies come to us and they, are raising a new round, or there's some specific issue in the business, or there's certain people that they want to speak to from a BD and a partnership perspective. So just crafting those pathways for their facilitating those intros, finding a way into certain organizations through our network. Um, but I'd say the bulk of my time is spent sourcing deals and then working on deals, which is definitely the fun part of the job.
Absolutely. Thank you so much for that. Before we go right into like the old juicy part, right? I really want you to tell us, the investment thesis at CVVC for the sake of the founders listening, and at what stage should founders engage with you guys?
Absolutely. So, specifically for our fund, right? We've got multiple funds. The other one's focused more on global, so predominantly Europe, North America, South America, with a global mandate. So our fund is an Africa-focused mandate. We invest pre-seed to Series A, so early stage founders, anywhere kind of along that life cycle journey, and we invest in blockchain and fintech founders. So let me break each of those down with a little bit more detail. So, what does Africa mean from a mandate perspective? Um, it's either the simplest African founders building African companies. It's African diaspora that we can also invest in, building in the sectors that we cover. But maybe a little bit less traditional is global businesses that are building with Africa as one of their core addressable markets. So if you think about, maybe an enterprise stablecoin payment solution that's focused on Africa, LATAM, and Southeast Asia, that's something that could also be a mandate for us. We could add a lot of value in terms of opening up that Africa market. When I say pre-seed to Series A, I mean I think those concepts are pretty well defined publicly, but um, we invest through two mechanisms. So the first is for all of our pre-seed investments, we have our internal accelerator program that we run. It's a 12-week program. 3 weeks are out at our headquarters in Switzerland. We have amazing partners like Google, all of the big blockchain protocols, etc. And we have standardized deal terms for those. Very, very much kind of like Y Combinator, Techstars, so it's very similar structure. We also do direct investments at the seed and Series A, or even those interim stages, pre-Series A, seed extension. We do direct investments, so no kind of programmatic investments. We just participate in rounds, although we don't lead rounds. So those are the two ways that we invest, and we're focused on blockchain from a sector agnostic perspective. So as an Africa fund, as all Africa funds, we're pretty fintech heavy. But we've invested across the agri-tech sector, the creator economy sector. We were speaking about one of our founders, Ikena, from out in the creator sector, out in Nigeria. So we can invest across the spectrum. And from a blockchain perspective, there's two things. They either need to have a blockchain within their tech stack somewhere. It doesn't need to be the main technological driver. It needs to be obviously serving a useful purpose within that tech stack, or companies that service the blockchain industry. So as an example, we have another startup that's quite big in Nigeria called OKHi, and they provide addressing infrastructure. But that solution can service the digital assets or the blockchain ecosystem as well. So you have it in the tech stack or you're servicing that industry. So yeah, I think that should cover it all from a stage perspective, from a mandate perspective, and a thesis perspective.
Yeah, thank you very much for sharing that. Now let's go right fully into the juicy part. You mentioned that you spend a lot of time with founders. So want to pick from your knowledge, right? What are some common mistakes that you see founders make repeatedly when raising capital, so to say? What are some common mistakes and how to avoid them, really?
That's a great question. Great question. I think one is trying to raise too early. So there's very few investors who are going to invest purely based off an idea and a pitch deck. There's a lot more you really need to do. I want to know, how deeply do you understand the market or the vertical that you're playing in, and what unique insight do you have that allows you to win in the space? And I think one of the big mistakes I see, and this is a mistake I made myself as a founder really, really early on, is not doing sufficient market research. So don't make assumptions about what needs to be built. Go and speak to customers. Ask them deep questions around what are their problems, what would they think of a solution that looks like yours, what would they be willing to pay for it, what would they need to see in that solution, how long would it take them to use a solution like that, what are the potential barriers to them adopting a solution like that. So doing sufficient market research and then developing a hypothesis of that and testing that hypothesis. So you don't go and spend a bunch of money on building a product before you've tested a hypothesis with the market. You'd rather get feedback and iterate on that. I think the analogy that I really like is, don't go out and build the whole car. Start with a bicycle and see how the market feels about the bicycle. And then you start adding parts slowly based on that feedback that you're getting from the market and you're getting from potential customers and existing customers. So raising too early without doing enough market research, without developing a very refined hypothesis and testing that hypothesis in the market. Two is really understanding the difference between an SME and a venture business. Venture is not for everybody. You can build incredible businesses that are lifestyle businesses or that are SMEs. Really understanding the difference between what scale a business has to eventually be able to reach to be a venture backable business versus, a great business that maybe, just does, 3, 4, 5, $10 million of revenue per annum, right? If that's the eventual scale of where you can get that, that's probably not a venture scale business. So really understanding if venture is the right business model or the right funding model, for you. And then I also think in today's day and age, there is an incredible amount of publicly available information out there about, how data rooms should look, how pitch decks should look. So I see founders making the same mistakes when it comes to pitch decks, when it comes to market sizing, when it comes to team slides. And there's so much publicly available knowledge out there, so much public templates, so much public best practices. It just shows me that you haven't gone out there and done the work to really understand how this should look and where this should be. Another one is having a really good view of, what your corporate structure needs to look like, and what are the things that need to be in place, right? As an example, for multiple reasons, um, venture investors are not going to deploy into a Nigerian holdco, right? You're going to have to understand, what corporate structure fits your business best. What are the licensing requirements around that? And you don't need to set it up on day one, because that's like people who have an idea and they go out there and buy the domain. Build the business first, then go buy the domain. Similar to just having an understanding of what that needs to look like, what needs to be in place. But I think those are, and I'm speaking probably more particularly around very early pre-seed businesses. By the time you've raised an institutional round, you have investors on board who are guiding you on, what your seed needs to look like, or the fact that you generally need to have your unit economics in order to go out to the market and do a Series A. So you're underwriting different things at different stages of the business, but probably where the most mistakes are made and where the most help is needed, I would say, at that really, really early stage. So the biggest mistake is, don't just build a pitch deck, have an idea, um, do no testing with the market, and then go out there and try and raise money. You're not going to be successful.
Yeah, right. Thank you so much for that. I'm sure somebody listening to this would have, picked some of their mistakes and, see how to sort of like go work around that. One of the other things that I'm curious about is, as a fund, right, or as a VC, what sort of like makes a great team, right? Say, oh, I love what this team is doing. Would love to invest in them. What makes like a great founding team, right?
That is a great question, right? And I think when you look at pre-seed and seed investing, right? Series A, you traditionally, like I said, your unit economics are right sized. You have generally a repeatable, scalable go-to-market playbook. Like there's a lot more metrics you can underwrite. But when it comes to pre-seed and seed, the biggest thing that we're really underwriting is the team, right? I'd say to a lesser degree, kind of the market that you're building in, and the vertical that you're building in, but predominantly it's the team. And the earlier you go, the more you're really underwriting the team. And I think what makes a really, really good team is, I think Silicon Valley, not so much Silicon Valley, but like the stories that we hear, the college dropout from Harvard who goes and builds a business. That's one way of doing it. But if you actually look at the market, that is not the typical archetype of the founder that is successful, right? It's a one in 1,000 kind of case. The typical archetype of successful founders is someone who has relevant experience within the industry vertical that they're building in. And, that means it obviously differs, but, have you spent 3 years, 5 years, 10 years working at a large financial services firm before you go, hey, I want to build a fintech company? And that gives you deep understanding of what it actually takes to build a financial services company. What are the compliance requirements? What are the data requirements around working with a large enterprise customer? What are the compliance requirements? How does the funding mechanisms work? Do you have the network to be able to go out and take this product to market if it's an enterprise or B2B product, for example? So relevant industry experience is crucial in the area that you want to build. It lets us know that you understand what this needs to look like to operate at scale, but you also have deep insights into the problem, right? If you're building a compliance business, but you've never worked into compliance, you don't really understand, how the sausage is made, so to speak. So you have a lot of blind spots. You don't really understand how the product manifests itself in the market. So that's one. You've got to have relevant industry experience within the vertical that you want to play in, or you want to build in. And two, we've invested in single founders before. It's not particularly a problem, but founding teams that have very complementary skill sets that don't overlap are incredible, right? You want someone with the charisma and the enterprise sales ability, or the go-to-market, if you're a consumer business, with that go-to-market muscle that really understands how to go out, acquire customers across various channels at the lowest possible cost. But then you also want a CTO type profile who's deeply technical, that can build really high quality products with a really high product velocity. So as feedback's coming from the market, they can incorporate that into the product. They can iterate, they can build new features, they can fix features, they can work on bugs. And that tends to be the typical archetype of a successful team, where you have someone who's a bit stronger on go-to-market sales fundraising, and you have someone who's typically stronger on technical and product. Obviously, there's a bunch of other skill sets which are relevant, but you want a team that across the board has deep, relevant industry experience, that have complementary skill sets that don't overlap, right? You don't need three, you can have, but like you don't necessarily need three CTO profiles, right? Because one, you're going to butt head a lot on technical aspects. You're not going to have a clear delineation of who at the end of the day actually owns the technical aspects in the product. But then you're not going to have the strength that you need when it comes to sales, go to market, fundraising, potentially, right? Sometimes you get people who are just superhumans who are great at both. So you don't want these overlapping skill sets. Traditionally, you want complementary skill sets and relevant industry experience. That is, what you really, really want. And I'll give you an example. If you're, because it's the easiest kind of example to give. If you're building a B2B stablecoin payments business, you want someone who maybe held a good senior role building B2B treasury products at Yellow Card, right? So they really understand how those products are built. And then you want someone maybe who's never worked in stablecoins before, but comes from Flutterwave, or who's taken financial service products to market. Maybe he was in the BD team or the growth team or the partnerships team, that has those relationships, but also understands how to take these enterprise products to market and sell those products and close those contracts. So ideally, that's kind of the team that you want in a founding team. Complementary skill sets, relevant industry experience. Probably took too long to say that, but yeah.
Yeah, absolutely. That sort of like blew my mind, and I'm sure like for the sake of those watching, also they would have gotten like a really really interesting point of view to what type of founding team makes like a successful product, as the case may be. Like you put it, you don't want to have like three technical persons on the board, or like you want to have people with different skill set that sort of like complement you know each other. Talking about like Africa generally, and also like how people build from this part of the world. We've seen over the past, years, the state of funding. Africa saw like a significant drop in funding, but sort of like an increase in deal count, right? What does that basically tell us? About the current state of venture investing on the continent, and what needs to be done to sort of like increase that count.
Great insight. Look, I think we've come leaps and bounds. It's always great to look at things and kind of the macro and zoom out. We've come leaps and bounds from where we were, kind of 5-10 years ago. The industry has really come into its own. It's matured. You've seen the emergence of even things like venture debt as becoming quite prolific, almost making up close to 50% of the overall funding mix in 2025. Although a lot of that went to very few players, asset-backed kind of models, but still good nonetheless. I think what worries me the most in the current state is the state of the right at the earliest stages of the funnel. So we're not seeing enough funding come in to the value chain from a pre-seed perspective, and that has knock-on effects that only manifest itself, in the next 2, 3, 4, 5 years, where you don't see enough companies coming to seed, coming to Series A, etc. So I think we need to see more funding at the earliest stages, and there's luckily some things that are coming in and plugging those gaps in the form of grant funding, etc. technical assistance. But I think we need to see more funding at the earlier stage. So we need to see more pre-seed funding coming into the continent and really giving founders the ability to take those initial shots on goal. And, that'll manifest itself into a healthier pipeline coming through the entire rest of the value chain. It's very hard to have strong seed stage companies if there's no pre-seed companies. Same with Series A. So I think as a continent, we really need to solve that pre-seed problem. And it's really funny because you've got this relatively healthy middle of the funnel, but right at the beginning of the funnel, you have an issue. But in the same vein, there aren't particularly many dedicated growth equity funders in Africa, right? So you don't have kind of household names that you go to raise a Series B, to raise a Series C round. And this wasn't as much of a problem during the kind of the ZERP era, right? So, very low interest rates. We saw a lot of global capital interest in growth rounds in Africa, the Tiger Globals of the world, etc., who were coming in and filling that gap. But, ever since I think we've come out of that kind of, almost zero interest rate environment, you've seen a lot of that global capital pull out of Africa, and it's creating, they were never really very active on the early stage, but they were the go-to funders at the growth stage. And with that withdrawal of capital, you aren't seeing that gap being filled by local investors. I don't think we have specialist investors in that space particularly. And, it's slightly being filled by the private equity funds, but private equity and venture are two very different games. The way we underwrite deals, the way we value deals, the underlying expectations around scale versus, kind of EBITDA profitability on day one and positive cash flows. And I think those are the two things that I would say we need to work on addressing as an industry. Obviously, I think the pre-seed issue is a lot more urgent and necessary in the short term than the growth stage part of the pipeline. But I think that is probably one. Two, I really, really love the emergence of sector-specific funds, right? And I think they're able to add tremendous amount of value within those verticals. So with us, having a dedicated blockchain-focused fund, with the First Circle team, having dedicated fintech funds, with the climate tech funds, like the Holocene guys have just raised a vehicle focused specifically on that space. I think the emergence of those vertical specific funds is a very, very healthy development for the sector, and it's going to do really well to see those individual sectors flourish, particularly at the earlier stages of venture, so pre-seed to Series A.
Thank you very much. I think that's like really, really, eye-opening. We need a lot of like pre-seed, VCs sort of like take not just the mid, say like Series A or like Series B. Do you think like angel investing can sort of like fix that, or like for people who don't get sort of like pre-seed by any chance, or like from friends and family, or like angels and all of that, do you think angels or like friends and family can fill in that gap for like pre-seed, or do you think the people investing at the Series A, like Series B, were not able to validate on time and left it to people to do their own due diligence, so to say?
I mean, that's a great question. Look, I think 100%. I think angels are a crucial part of the venture ecosystem. Right? We've seen what they've been able to produce in kind of some of the more developed markets. I think it's a layer that's tremendously lacking. So spot on, great question. Within the African venture ecosystem, it's becoming more prevalent as people are being educated. You have, incredible organizations like the ABAN network, and there's a lot of regional networks, and people who are really trying to educate the market. Particularly those who have the disposable income to be able to angel invest. Right. We've also got to be cognizant of the fact that there isn't that much, discretionary capital just floating around for people to be writing $5,000 checks, $10,000 checks. $1,000, $2,500 checks. Um, so I think the venture ecosystem is trying to do it very well. I actively do a lot of angel investing outside of kind of the fund thesis. So other areas. I actually just deployed a check for a deal with the Summit guys, who are incredible, yesterday or the early hours of this morning. So you're seeing a lot of it in the venture space, right? Like Zach and Junaid from Launch Africa Ventures, a lot of the other GPs, but you need a lot more than that. So I think there's an education and a structure gap that needs to be closed on the angel side. And I think education needs to happen at kind of that corporate, corporate executive, senior operator level, like, people at the big banks, at the big fintechs, at the big consumer brands, really educating on them on what is angel investing, how do you do it, and then second to that, making it simple for them. So, you know, um, Joe Kinvey and the guys out at Hoke and Borderless are doing an incredible job of this. And okay, once you're educated and you have the appetite and you're able to deploy these angel checks, where is the deals and the infrastructure for you to do this? And that's really where they're stepping in and they're doing some incredible work. So I think we're on the right trajectory, but um, the delta between where we are and where we need to go is quite significant. But we're getting there. People are doing the hard work to make sure that we get there.
Yeah, absolutely. I think I love like the last word. Like people are doing like a lot of hard work to get to where we want to get to. And so if somebody is a first time founder, right, what's like a playbook that you recommend for like, fundraising?
So if you're a first time, and again, I love being transparent with founders and kind of balancing the realities of kind of, just the way things operate. If you're a first time founder and you don't have significant industry or operator experience, you weren't an early hire at Flutterwave, or you've been there for the last 4 years, or MoneyPoint, or Andela, or you haven't been working at Visa for the last 5 years. And I'm speaking, we're very focused on fintech, so I tend to use those examples a little bit more. Um, uh, you are going to have a more difficult time fundraising. So what that means is you're going to have to look at alternative methods of financing, whether it be grant funding, whether it be bootstrapping. You're going to have to take a lot of risk, whether it be friends and family. Can you get a couple of family members to cobble together $10,000 and put it in your business? Operate as lean as you can. I think with AI today, that's made it more possible than ever. And you're going to have to give proof points. So for first-time founders that don't have significant industry or operator experience, you're going to have to start throwing up very, very good metrics before you're going to have a successful time, raising a formal round from kind of institutional VCs. So, I start those conversations, show them how well you execute and that you've got a good execution cadence, and that, when you say you're going to do something, you get it done. But realistically, you're going to have to, I mean, obviously it depends on business model. So I'm using random numbers, but you're not going to be able to fundraise with a pitch deck and an idea and an MVP and no customers. So you're going to have to build something. You're going to have to take it out to market. You're going to have to acquire customers. And you're going to have to put some revenue points on the board before you're able to successfully fundraise. And, before that, you're going to be, fighting a very, very uphill battle. If you've built and exited a company before, you can raise off an idea and a pitch deck. If you have been a significant operator before, with deep industry experience, really unique insights in a very interesting market, you can raise off of a deck, a team, and maybe an MVP. But the further down you move down that stack, the more proof and points you're going to have to put on the board before you fundraise.
Thank you so much for sharing that. You mentioned like some alternatives, right? Say like friends, and family and all of those things. But prior to this conversation, you mentioned like venture debt, right? I want you to really like go, deep into that. For the sake of those hearing for the first time, what's like venture debt, And how do you see that sort of like evolving in Africa?
So great question. Look, I think venture debt, and I'll go into what it is next. Venture debt stepped in at a really important time when we saw this significant drawdown in primary equity capital being deployed, kind of again, kind of this, post ZERP era. And for those who don't understand, it's zero interest rate policy. So like, interest rates were very low in the US. The cost of capital was essentially free. People were very risk on. Times were good. Post that ZERP era, you saw the significant drawdown in capital globally. Appetite changed much more towards risk off, and the most we're right at the end. Venture capital is right at the end of the risk spectrum, right? You get like government debt, public equities. We are right at the end. So when things go risk off, we're the first and most significant area of pullback. So venture debt stepped in at a really, really important time. I mean, to keep it very simple, venture debt is essentially it's debt, right? So the same way you take a loan from a bank, but these are capital allocators who are specifically structured to lend to venture capital backed businesses. So, however, and there's ways that are specific to venture, like they build in specifically like equity warrants, and don't worry about all of the technical stuff. It's just debt. It's a loan, and loans that are specifically tailored towards VC-backed companies, technology companies. But venture debt is not something for an early stage startup. So you'll not be able to raise venture debt as a pre-seed, seed, potentially even like a Series A company. Venture debt is for companies who have predictable cash flows, significant revenues, where you can prove that you can actually service that debt. So as an early stage founder, looking, what are the different funding options I have? Venture debt is not kind of going to be in your repertoire of available funding mechanisms. So what I'm really talking about when speaking about the alternative funding mechanisms, primarily is grant funding. There's a lot of amazing programs out there that are really geared towards helping you get from 0 to 1, helping to kind of catalyze that early startup founder journey. It's either industry specific. So if you want to build something in the climate space, there may be programs specifically tailored to climate funding, etc. In the blockchain space, grant funding is very well known. Traditionally comes from different blockchain protocols to kind of incentivize you to build on their technology stack. So Solana, Base, Stellar. All of them are very actively deploying grant funding on the African continent, obviously, provided you're building on their technology stack. So that is probably going to be the best source of your 0 to 1 capital, before you're able to kind of raise venture capital dollars. And there's also some incredible programs out there, right? So incubator programs, the startup boot camps of the world, etc., where not only are they able to help you from a capital perspective, but they're also able to help you from really understanding that venture business and how do you turn this into a business? How do you validate your ideas? How do you validate and build a viable commercial model? So they almost help you in that 0 to 1 journey to bring your idea to life. And then oftentimes that comes with a capital component as well.
Thank you very much, for going deep into like the alternative source of funding, especially for like early stage startup. And I think like you drove the point home about like venture debt, particularly the fact that, it's not for early stage startup, right? You need to be able to prove, that you can service like the debt, right? Earlier on, you sort of like mentioned that, you do like a lot of market research and, those stuffs. Let's get, your point of view as regards like stable coins, RWAs, especially like in Africa, right? Stable coins are becoming like one of the biggest product market fits, right? What opportunities do you see emerging in Africa, especially for like local stable coins and also like sort of like RWAs, as the case may be?
So great question. Coming to the stable coins point first, I think what we've really seen kind of materialize over the last call it 2 years, the stablecoins have really transitioned from this retail phenomena to this enterprise phenomena, and they've really transitioned from consumer facing to infrastructure. And I think you can see this in kind of the businesses being built, right? The honey coins of the world, are really providing that enterprise infrastructure layer that allow you to build these capability sets within your business. Predominantly, these B2B businesses, which is really interesting. I think that has come largely as a function of global sentiment, but also regulatory clarity. So before we had clear regulations in markets like Nigeria, like South Africa, we're getting there in Kenya and Ghana. Big businesses obviously weren't willing to touch them and use them. The big banks weren't willing to bank some of these companies. But as that regulatory clarity has come about, it's now opened the playing field in terms of who can use these things, who can integrate these things. So I think we're really seeing this transition of stablecoins from a retail consumer phenomena to this enterprise and infrastructure phenomena, especially where companies are trying to abstract the whole blockchain component from the end user, where they just get the benefits, but they don't need to deal with chains, with wallet addresses, et cetera, et cetera. So I think stablecoins are the opportunity from a B2B infrastructure perspective is incredible. And that's not just the movement of money from A to B, right? As it moves from a retail or a consumer phenomena to an enterprise phenomena, big, large-scale regulated entities need more than just the ability to move money from A to B. They need compliance infrastructure. They need clearing and settling infrastructure. They need interoperability infrastructure. They need like the amazing work that Abdu and Morgan are doing at BlockRadar. They need wallet management infrastructure. So it's all of these things surrounding the movement of money that become necessary in this B2B infrastructure age. I really think on the RWA tokenization side, I think we are now on the RWA side where stablecoins were 3 or 4 years ago, where you've got this very clear view to how transformative they are and how incredible this technology primitive could be to different areas of business. But we haven't seen that materialize into scaled business models yet. And I think that's really where the huge growth opportunity is over the next, I can't look into my crystal ball. It might be 2 years, might be 3 years, might be 5 years. But I think that's really the next, when it comes to kind of blockchain, financial market infrastructure and capital markets infrastructure, that's the next incredible opportunity. We're already seeing businesses tokenizing accounts receivables. We're seeing businesses globally and in Africa tokenize private market stock, tokenize public equity stock. We have a portfolio in a company in our portfolio, Altify, where you can, as a retail investor, go and buy institutional grade private credit from $100. You can go and buy US stocks. You can go and buy US indices. And all of that is being enabled by tokenization as a core technology infrastructure. So when it comes to what the next big growth opportunity is, I think the Nalas, the Flutterwaves, the Honeycoins, they're all big businesses in the stablecoin space at the moment. I think over the next 3 to 5 years, we'll start to see that scale of business starting to emerge in the RWA tokenization space. That's where we're really excited to be investing in those businesses today and hopefully seeing them scale to those heights.
Yes. So thank you very much for that. As we sort of like bring the pod to like a close, right? Fast forward to like 5 years from now, what has to happen for Africa to sort of like win, right?
Great question. I would love to see that. And I think we're on that path already. I think people forget that the huge wins like BVNK, which was acquired by MasterCard, started as a South African business by South African founders. So, I really want to see more of African founders. And I think BlockRadar is a perfect example of not just building African businesses for Africans, but building world-class technology and exporting that to the world. What do we need to do to win over the next few years in the, let's call it the blockchain and fintech landscape? I think I would say probably 2 core things. The one is there needs to be sufficient funding at the earliest stage of the funnel to allow these founders to go out and try things, right? To go out and try and build the next big audacious business that's solving problems. So there needs to be sufficient funding for the industry. For those who haven't seen, we just published last week the latest edition of our Africa blockchain report that we co-publish alongside Absa Bank. There's incredible data in there about funding, etc. But African blockchain receives 0.5% of global blockchain funding. When you look at the level of adoption and the scale of these markets, that is just atrocious. So we need to see more funding going into the space to allow more of these founders to be taking these shots on goal. And I think we're on the right trajectory. We need not just regulatory clarity, but good regulation. I don't want to comment on different markets, but there's some acts, that have passed that the industry is really against, that they're really not productive to a good, fruitful industry. So I think we need clear, good regulation. But more than that, if we really want to give our companies a chance to succeed here, we need more regulatory harmonization. So it can't be an uphill battle and an 18-month process and hundreds of thousands of dollars, tens of thousands of dollars every time you need to scale into a new African market. We've started to see some of this fintech licensing, passporting, I believe, between Rwanda and Kenya. We need more of that, it's at least across regional blocks, right? So, the SADC region, the ECOWAS region, etc., at the very least. But more Pan-African regional harmonization, clear, good regulation, and more funding. I think if we can get those two things in place, or let's call it three things, I think we're in a very, very good place to succeed over the next 5 years.
Thank you so much for sharing that. And that's a lot to take in, right? Thank you so much, Brenton, for sharing like your journey, your insights, and also like thought process on helping founders grow and scale. So if this conversation made you curious about what Brenton and the team are building, be sure to follow him on X and check out CVVC and also CB Labs. And if you found this conversation valuable, please like, comment, and share, and subscribe to the channel for more conversations as this. Thank you for watching, and I'll see you in the next episode.
Cheers, everyone.